Hi, I'm Mark and welcome to Little Known Stocks, the show where I try to prove that being boring and doing your research will make you money. Now, speaking of boring, we're going to talk today about a sector that is normally incredibly boring, and that's insurance. But this company, LMND, are looking to disrupt this sector by being particularly a high tech stock, and they're positioning themselves very much as a tech stock rather than an insurance stock, using a high amount of data and focusing on the customer and a real customer experience, doing everything through an app, making payments very quickly to make the experience really much better than those of their competitors. So I'm just going to play you a little clip that shows what issues there are in the insurance industry today, and
that insurance may be the largest disruptable industry on the planet. Even though neither of us had come from the world of insurance, we found three things in insurance that just about never come together, that elusive trifecta. The first one was just how vast the insurance sector is. In America, you're talking about something like 11% of GDP, and it's about $5 trillion worldwide. Some of the largest insurance companies in the world do over $100 billion a year, but none of them has above 4% market share. The idea that you can be a Fortune 100 company and have only 4% market share, that just blew our mind. The second thing that we found was that it's largely unchanged. It's really dominated today by the same companies that dominated 100 years ago, and sometimes 200 years ago, and sometimes 300 years ago. In the United States, 12 of the Fortune 100 companies are insurance companies, and their average age is about 125. 125 years ago, there were no airplanes, there was no air conditioning, there were no antibiotics. So the world has been transformed, but insurance really hasn't. That speaks to a profound opportunity for innovation. And the third element is that it's a deeply unloved sector. In the Urban Dictionary, the crowdsourced definition for the word insurance is a business that involves selling people promises to pay later that are never fulfilled.
So what's really key to the LMND ethos is their focus on the customer and being customer centric. So they are not only ranked first on ClearAssurance, which is a comparison site in the US, they're not only ranked first for customer service and customer claims experience, they're also ranked first for price as well. So really, really strong results and strong perception of the company for those who use it. So another area where LMND look to differentiate themselves is a fixed fee basis. So this allows them to operate and pay claims, whereas other insurance companies will try to avoid claims because they want to essentially make as much revenue as possible. So I'm just going to play another clip that explains exactly how LMND do this and why they do it.
At LMND, when you pay us $1, you know in advance that we will keep a fixed fee, currently 25%. We use the remaining 75% to pay your claims and reinsurance, and if there's money left over at year's end, we give it back to nonprofits of your choosing. These two programs, our charitable giveback and our reinsurance, they act as ballasts, stabilizing our flat fee, and we believe that changes everything.
So one of the ways that LMND really build the trust in the customer base is taking a fixed fee. So they take 25% of the total premium value as a fixed fee up front. So you know exactly what's going towards the company. The remaining percentage of the pie is basically used to pay out on claims, and anything that isn't used is then used basically to give to charities of choice for the customers. So the more efficient LMND is, the less they have to spend, but they don't actually drive more revenue, which is both obviously a positive and a negative. It's a positive from customer service because you know that they're not going to try and scam you out of any money when you make claims. There's going to be no fine print stopping you making that claim, but also, you know, it limits the amount of potential. So as the LMND algorithm gets better at predicting risk and making the premiums better and choosing the right premiums, they won't be making more profit, which really is congruent to their business model. So LMND measure three key KPIs. The first one being premium per customer, $229, up 25% year over year. So their existing customers are buying more, which is great. Total customers, which has grown 50% year over year, also very strong, which overall gives this in-force premium when you multiply the two numbers together of 252 million, 89% up year over year, which is really, really impressive. Now it's worth saying that's not the same as revenue because obviously you buy a policy, it lasts 12 months. So it's slightly ahead of revenue. It's a little bit of a cheat in a way, and that will come through over the course of the next year. They also say that they're going to monitor this KPI going forward, so annual dollar retention, and this is the number of customers that they can retain rather than lose to their competitors. So 81% is really impressive. If they manage to keep 81%, that means they keep the customer that they've got and they continue to grow through expanding their customer base, which is really impressive. And obviously, as we've already said, those customers are likely to spend more over time as they buy not one policy but multiple policies across the Lemonade brand. So Lemonade take 20% of the premium as their earnings, which means the other 75% is used to fulfill the claims. So they need to keep their loss ratio, so the amount that they're getting in premiums versus the amount that they're paying out in claims, below that 75%, otherwise it will start to eat into their revenue and their profit. So you can see the loss ratio over time has come down, 87% in Q1 2019, and when they really started out, they didn't have data of their own. They were relying on industry data that they had to purchase from other insurers. But as they've collected data over time, you can see that it's come down and down and down and started to level off at around 72-73%, with Q2 2020 below 67%. Worth noting that they did have the Texas freeze here, which drove it up to 121%, but they had reinsurance in place for crisis, and I'll talk about that in a little while. So if we take 72 to 73% as their loss ratio, that means that the 75% is sufficient, although most of it is being used and there's not much room for error there. But if we look at their competitors and some of the other stocks, you can see United Health here, premiums 55 million, medical costs 44 million, that's around 80%. MetLife, premiums 42 million, benefits and claims 41.4 million, that's about 98% even. So I looked at a few of these, I couldn't find anyone really as low as Lemonade. The 73% is really strong. Thinking about some analysts as well, they do predict it to go down to more like 65 to 67%, which would be even better, and really give them a strong buffer in times of crisis. So what is reinsurance? Well, it's pretty much what it sounds like. Lemonade sell the policy, they take their 25% fee, but then they pass the policy over to another insurer who basically will cover any claims, and they own the financial risk then of that. So 25% is quite a significant fee, and while reinsurance will protect the balance sheet if something like this Q1 result happens and they do exceed the 75% or even 100%, it can't be consistently like that. So this reinsurer will want to be seeing profits, so that if they're paying 75% for the premium, they'll want the loss ratio to be below 75% so that they can make a profit. If this happens as a one-off, they may continue to insure. They may raise the price of the premium and renegotiate with Lemonade, which could potentially cut into that 25% or mean that they don't do business with Lemonade in the future, which would be bad. And if they continue to see greater loss, they just won't do business with Lemonade. So it's really important that although they mentioned that this loss ratio didn't hit the bottom line this quarter, it's really important that they don't have another loss like that, because it really will impact their business model over the long run. So reinsurance is constantly sold on the earnings calls as a really, really good thing for Lemonade, which limits their risk, but we can already see there's potential downside to that. But the other thing that it potentially does is it massively limits their revenue. So the in-force premium here that they're selling as their top line number, as I said, isn't the same as their revenue. And their revenue is the 25%. So if we look at their revenue as 120 million, that's the full year high estimate, even based on a massive decline in the share price, I think from 163 down to $69 a share, market cap of 4.26 billion, that represents a price to sales ratio of 35, which is really, really huge, particularly for a company where there's a lot of really cheaply priced alternatives already existing in the insurance market. So That's a really bad thing. And I think Lemonade potentially have the option to scrap the reinsurance model. You can look at their cash balance on their balance sheet. They've got over $1 billion sitting around in cash, but the problem is they are continuously losing significant amounts of money. So they'll lose 163 million this year. That's substantial, very, very substantial. And so they probably can't afford to do that at this point. But that's certainly something I'd be looking for them to do in the future as they grow and as their balance sheet grows and as they hold more cash. So Lemonade do declare on their website that they are rated A by the insurance industry, exceptional, so they represent very low risk. But when we look at the underlying document, it's an annual statement. This one's dated December the 31st, 2019, so there isn't a 2020 version uploaded onto Lemonade's website at the moment. I doubt based on the 2020 numbers it will have changed, but it will be very interesting to see once that 2021 number comes in, and we've obviously seen a very poor Q1, whether this changes and an A rating slips to a B or worse. So the other way that Lemonade claims they differentiate themselves from their competitors is the use of data. So I'm just going to show you a short clip where they go through how they sign you up and what sort of data they collect.
When you interact with our bot Maya, you're asked far fewer questions on average before giving you a quote. While you're only asked to answer 13 simple questions, our bot collects more than 1,600 data points. That's up to 100 times more data than traditional insurers.
Maya doesn't miss a beat. Every element of the interaction is captured, aggregated, and regression tested for correlates with claims.
Being fully digital lowers the cost of acquisition, increases retention rates, and earns us high ratings by customers. But it also generates datasets that are highly predictive, highly proprietary, and unavailable to traditional insurers.
When we launched, we had no data of our own. So we purchased basic industry information and started pricing and selling policies based on those data. It turns out that at 20 data points, much of humanity looks very much alike. And you price and underwrite large numbers of people as if they are a uniform, monolithic group. But what we found is that the data we were gathering, that 100x digital zoom we have, it showed us that groups that our competitors seem to consider to be monolithic were actually made up of predictable subgroups, with over 600% variation in their likelihood to file a claim. 600%. All this based on data that is available to us and unavailable to the industry at large.
So Lemonade really do collect a lot of data, and it seems they collect a lot more than other insurance companies, but I don't think this is something that will remain unique to them going forward. And one example is Telematics. So Lemonade say that other insurers collect a small amount of data, that they group people very closely, but Telematics is not just used by Lemonade, so Lemonade track your phone, but certainly in the UK, people have had black box telematics in insurance for some time, which tracks things like the braking, cornering, steering, speed, the time you drive, the mileage, etc. So really insurance companies are evolving with data, and they will get better as time goes by as well. And what I do see as a big potential competitor in the future with telemetrics is the actual car manufacturers themselves. Now Tesla are offering insurance in California at the moment, but there's no reason why they shouldn't expand that very rapidly as time goes on. Warren Buffett is famously not a fan of this. He thinks it's not going to work, and traditional insurance will win. But it's something Tesla are very, very, very hot on, and they're really looking to introduce this globally. So as more cars evolve and cars become more like computers in the future, the car manufacturers will hold a huge amount of data that people like Lemonade won't be able to get. I do think, given the amount of information Lemonade are collecting, though, there is a potential that they could price their premiums cheaper than others and therefore grow their revenue more. But one of the things I think it can really help with, and they've already demonstrated this, is their structural costs. So the main argument that they're making versus competitive insurers is that insurers are very old, they're very structurally inflexible, they've got a lot of fixed overheads that Lemonade don't plan to have. Plus they're built that way, so it's very difficult for them to change, whereas Lemonade as an agile startup can really start fresh. They've got one computer system, whereas if you're sitting in a big insurance company, you might use SAP over here, you might use Oracle over here, you might use an array of different systems. They have one system, it all speaks to each other, very low cost, probably very low human interaction with that system. But they're also driving down their costs through constant evolution of their AI. So I'll just play you a short clip now to show how that is being done, and it could really impact them and make them much more efficient over time.
A great example is how we automate a lot of the things that humans used to do. We do it through AI. We got a lot of customer tickets about moving. We realized this is something that a bot can do. And once we implemented that into production, we saw a huge drop in customer time to answer tickets. And we saw a huge increase in the way our AI was now answering customers.
In early 2018, only a small fraction of our customer inquiries were handled by an algorithm. That number increased to about a third of all inquiries in the second quarter of 2020. That's more than a 5x improvement.
So one of the things that I'm extremely bullish on with Lemonade is their total addressable market. So the Insurance Information Institute gives us some numbers here for various different industries and the insurance behind that. I've broken it down into a table. So pet 1.8 billion, life insurance 254 billion, home insurance 637 billion. Now they're the areas that Lemonade currently cover. But they are missing out the two biggest sectors, and that's car insurance, which they've just announced they are about to provide, which is 730 billion, and health insurance, which they're not in at the moment, which is the largest at 757 billion, and these are just the US numbers. So car insurance coming on board will give them an immediate boost, and remember, part of their strategy is to sell new policies to their existing customers, so there may be a big uptake from the start with car insurance, which could be really, really strong for them. Health insurance they haven't mentioned yet, but what I think they're doing is they're testing the data, that they'll learn the data of car insurance, develop a very strong model for car insurance, and then they'll move on to health insurance. So really there is a sizable growth opportunity, and this is just the US as well. So I think their business model and being very data centric means that they can potentially lift this model and apply it to other regions around the world as well very successfully, which not a lot of insurance providers currently do. Now, the other thing to note is their competitor size. In terms of the top 10, you can see there's some absolutely huge companies here. These are in billions of dollars. So they're direct premiums, which means not reinsurance. MetLife are the biggest at 103 billion, absolutely huge. And then you can see another 10 companies all above the 22 billion mark. So absolutely massive opportunity. And there are some really significant companies in this sector that Lemonade are looking to steal market share from. So that's all I've got time for. If you like the video, please give a thumbs up and subscribe. In summary on Lemonade, I think they will get to their valuation, but I just think they're too expensive at the moment. I really want to see them build and maybe get rid of the reinsurance model to try and build quicker, but they're in early days and I think they will be a success. I just think it's going to take too long to get to where I need them to be from a price to sales and hope and earnings perspective. So that's all I've got time for. Thank you for watching. Have a good day.